I actually thought I'd start today on the Fed since they're meeting in Jackson Hole later next week, and Bernanke has occasionally said something interesting at the Jackson Hole meetings, and then we'll get into some of the other commodity topics. I'm required by our lawyers to tell you that I don't give investment advice. I frame the issues, and I encourage you to trade actively. This is one of my favorite charts that cannot be sustained. This is the 10-year bond yield minus the current inflation rate, or the inflation rate measured from this year to a year ago. And it goes from 1982, and it just goes straight downhill. But we used to have a 6% premium of the bond yield over inflation. And then we worked our way down, and this is zero. There's nothing left. The 10-year bond yield and the inflation rate are in spitting distance of each other. Now that means that if you buy a 10-year U.S. Treasury, you're basically not looking at any real return on your investment, unless you believe we're headed for deflation, and in which case you'll be very excited that you bought these things. But unless you have a horrible view of the future, multiple financial disasters, Europe imploding, it getting worse here, you really shouldn't be buying these things. So you might ask, who's been buying them? Since 2008, the Federal Reserve has bought over $1 trillion of these things. China's bought hundreds of billions. Most of the emerging market countries have bought a couple hundred billions. All central banks. You connect the dots, but central bankers are not profit maximizers. They're buying them for other reasons. This market, these treasury yields, they're either going to go lower because the situation, just financial disaster repeats itself, or we're at the end of a bubble and you can short these things for the rest of your life and do fine. However, as I remind you, the timing is totally unclear, and that was not investment advice. It's just warning you that this is one of the most interesting bubbles for me in the macro picture. One of the reasons it stays this way for a while is how many trillions the Fed has bought. And so that gets me to a few comments on the Fed. And I did want to give you just a little bit of background about the economy, things we all know, but perhaps the glass is half full view of things. This is the quarterly GNP picture of the United States from 2005 to 2012. And from 2005 through 2007, right before the first down quarter. The first down quarter was the first quarter of 2008. Okay? That 3 years, those 12 quarters, we averaged 2.4% real growth and with some volatility. And then we had our crisis. And since the third quarter of 2009, we've reeled off 12 straight quarters of growth. That one right there, that's still positive. So 12 straight quarters of growth at an average rate of 2.2%. Now, the only point I want to make here is that 2.2 and 2.4, there's not really any difference for us economists between those numbers. 2.2 is just slightly slower. So the economy in the United States has done just as well on a GNP basis, or almost as well, in the 12 quarters we've just finished as compared to the 12 quarters before everything went bad. So if you look at that picture, it's really hard to understand why the Fed is in emergency mode and so paranoid. Let me give you the obvious reasons we're not growing even faster. The two most obvious reasons for me are the global headwinds and labor force issues. And when I mean labor force issues, I mean structural problems that are hard to solve in the short term. So I'd like to talk a little bit about those things. I won't talk much about Europe. Europe is a mess. It's not growing. We all know that. We've all gotten the email. But it is. Europe makes up 20% of China's exports. And they used to export 10 or 15% growth rates of those exports. They're gone now. They're not, the exports aren't gone, but they're not growing anymore. They're shrinking. Brazil exports to China. You know, China is everybody's first or second largest trading partner. It's either us or China. And so it's a huge slowdown for the world, but also for us, that Europe is a mess. And then China itself is slowing down. It's moving from an infrastructure economy to a consumer economy. There are lots of things going on there. It's slowing down. So with Europe slowing down and China slowing down, it's pretty hard. You wouldn't be forecasting rapid U.S. growth anyway. Our exports are going to slow. Labor force. Let me talk to you a little bit about the labor force. This is what I call a smooth trend. In my smoothing, I've taken 5-year averages of the U.S. labor force and how it's been growing. And these are percentage growth rates. And in the sweet spot was right here. This is 1976 through the 80s. And even this is pretty good. This is 1.5% growth. This is 2.5% in the 80s. And we move into the 90s, it slows down. And then right now, the labor force has really slowed down. Now, typically, the labor force, even though I smoothed it out over 5 years, when you have a recession, people drop out of the labor force. And then when you get out of the recession, they come back in. So we're pretty much expecting this thing to come back up to somewhere around here. Here is 0.5% a year of additional labor force growth. So that just means our economy is less dynamic. I mean, if you kind of think about how fast an economy can grow, an economy with such a strong capital base like the United States, we're going to grow when our labor force grows, more people working, produce more stuff, or we're going to grow from capital improvements in technology. And technology on average, again over like a 5-10 year period, might be worth 1.5% a year. The labor force is worth 0.5%. So we're a 2%, maybe let's be generous, we're a 2.5% long-run economy now, whereas before we used to be a 3.5–4% economy, and then a 3–3.5% economy, and now we're a 2–2.5% economy. That's just what happens when, unfortunately, you get old, you slow down a little bit, you know. This is what it means coming out of recessions. This is 1982, and this is the, this is the 1982 recession. This is the savings and loan crisis in 1990. This is the tech wreck, almost recession. And this is the big one we just had. And what we're looking at here is job growth. And each time we come out of one of these things, we used to have like 4 or 5% employment growth. And then it became 3%. And now it's coming out of this one, you know, 1.5%. Every recession since 1990, we've had a slower comeback in job growth. Now, part of the reason that happens is that over the last 30 years, think about our technology. Our technology is largely what we economists would call labor saving. What that means in a more positive sense is that it makes labor more productive. But in making labor more productive, for a given amount of GNP, a given amount of expanding your business, you don't need quite as many people as you did 20 years ago, 30 years ago. So it's very, very hard for the Federal Reserve to actually make employment grow faster because they can't fix China. They can't fix Europe. Europe can't fix Europe. And technology is just more and more making labor more productive, with the side effect that when you want to grow your business, you don't need to hire as many people. And so when you come out of a recession, you don't hire as many people as you did before. None of these are things the Fed can fix. So the problem I have with the debate about quantitative easing is, do we really need a QE3 or a QE4 and more things when they're unlikely to work? If your goal is to get more job growth, you really want to get more consumption, because consumption is what would make corporations more positive about the economy and make them want to expand. Zero interest rates don't get corporations to invest more. Why? Because their problem isn't low interest rates, they're full of cash. Major U.S. corporations are cash rich right now. Money to invest is not the issue. The issue is their confidence in the future. And that they don't have a lot of. So, you know, that's not something the Fed solves by buying treasuries or even by buying mortgages. So, you know, this is going to be the debate at Jackson Hole. Bernanke's going to give a speech on Friday evening, or Friday afternoon, I'm not quite sure when it is, next week. In the past, in 2010, he did announce QE2 at that conference, so we're all like paying attention. And then there's a Fed meeting on September 12th. The minutes of the last Fed meeting were kind of pessimistic. They were saying if things don't get better, we should do more. And ever since that meeting, things have looked a little better. So we don't know quite what they're up to, and it'll be interesting to see the speech. But my point to you is that even if they do QE4, you know, I'd sell into that rally because it isn't going to work. The problems that we have are either abroad or they're things the Fed can't solve. And the biggest problem we have internally is the fiscal cliff on the Congress side. We're going to hit that, and then they're either going to solve it or not. That's what the new Congress will do early next year, and there's nothing the Fed can do about that either. No matter, I mean, all they can do is talk, and they're going to convince no one. So that's the framing of the debate, if you will, for the Fed. Let's go to the energy sector. My favorite chart on energy is to compare the BTU price of oil and natural gas. Or said it wrong. If I gave you $1 and you spend it on natural gas, you get about 300,000 BTUs. And if I give you $1 and you spend it on crude oil, you get about 90,000 to 100,000 BTUs. So this chart has been scaled so that the price, the solid line price of crude oil is over here on this axis. So when it's like 95 bucks, that's the same in BTU terms as natural gas, as if natural gas were on this scale at about $15, that would equilibrate the energy. But instead, natural gas is down here at 3 bucks, and we have this huge gap in the BTU content of how you acquire your energy. Now, this is not a sustainable gap for economists. We look at this thing and we see opportunity. This is, of course, why we don't run companies or manage money, because to take advantage of this opportunity, you have to do things like spend $1 billion building a plant down in Louisiana to turn this natural gas into heating oil. And it's going to take you 5 years to build a plant, and if the price of natural gas goes way up in those 5 years, you're toasted. However, there's a company doing just that. If you're in Qatar and the Middle East, you're getting natural gas coming out of every one of your oil wells. You liquefy the stuff, and you put it on a boat, and you try to compete with Russia selling it to Europe. And that's going to happen more and more, but it takes time. And liquefaction of natural gas it's expensive, but at this price spread, it's quite profitable. And then, of course, you got pipelines you have to build. Part of the reason that price doesn't move is the U.S. pipelines don't always flow in the right direction, so we reverse the Seaway pipeline. The Canadians would like us to have many more pipelines. We haven't been actually good partners on that, so they're going to build them anyway to some other place. So you have infrastructure issues, and then even you have how you use your natural gas. The first thing people do, electric plants shift from coal to natural gas. And then transit systems may buy more buses that can run on natural gas instead of gasoline. But all of these things that will arbitrage, if you will, or eventually narrow this gap, require billions of dollars and take years. So this thing doesn't go away right away, and in fact it can even get larger in the short run, but it's not going to last. This is the kind of price incentive that brings out the entrepreneurial spirit in lots of big businesses. So trading this spread, the natural gas spread, against the crude oil spread, trading natural gas versus crude oil as a spread, is going to be, I think, one of the more exciting things over the next 4 or 5 years. What's interesting, though, is to also think about what the 5-year pricing already is. Well, if you look at the 5-year out natural gas contract, it actually takes it up to, up another 30, 40, 50%, depending on where it is today. Whereas the oil 5-year out contract is relatively flat. The 5-year out contracts are all a lot more stable than the nearby contracts. But they do suggest that natural gas will bear a heavier part of the burden of equilibrating this energy content than crude oil will. I'm not 100% sure of that. And the main reason is the demand side. I really see that China is going to slow down for a longer period of time, and that Brazil is a lot slower, and all of the emerging market countries are a good bit slower, and then I can't see them coming back really fast. And they were really the drivers that got us to $100 oil over the last decade. So if you take that driver away or slow it down a lot, it may be that that the burden of adjustment between this gap may be a little more, I don't know, 2/3 natural gas, 1/3 oil instead of 100% natural gas, 0 oil, which is kind of what the market is saying today. But from a point of view of trading, the spread may be more interesting than the direction over the next 2 or 3 years. We'll see, but that's kind of how I frame that one up. By the way, just by way of background, when I said that the emerging markets were driving the energy costs, this is what I have in mind. This is a cumulative GNP growth over the last decade. And these countries are at the bottom. That's China, India, and Brazil. I mean, they so far outgrow the US, Japan at the top. I mean, they just left us in the dust. Now, on the same scale, this is my forecast for the next decade. They still outgrow us. China, India, and Brazil are all growing pretty fast relative to the industrial countries, but the gap has narrowed quite a lot. And this is a decade forecast, so we're actually in a period where they're even slower. So that kind of takes an edge off crude oil demand for a while, and then it eventually will come back and we'll keep heading up. I mean, the long-run direction is up, but the short run might last a couple of years, not just a couple of weeks. A little bit on FX. I stuck this in here. I call it FX in a ZIRP world. ZIRP is zero interest rate policies. And the thing that I want to emphasize is that there's a relationship. We economists call it interest rate parity. But you have an interest rate in the currency you want to go long, the carry trade, an interest rate in the US, which is basically 0, or in Europe, basically almost 0. And then you have your spot exchange rate, and I got to change that to futures, your futures exchange rate. And those are your 4 corners of what I call the volatility box. And if a country like Brazil wants to control, it has to decide whether it wants to control its interest rate or its currency. And Brazil, for the most part, lets the currency move. Not totally, but they spend more time controlling their interest rate. A country like China, interest rates don't mean the same thing. They control their currency. And so what you see, I've scaled this back so that I've kind of put them on the same scale, but the dotted line is the Brazilian real, and it bounces around a lot. And the blue line is the Chinese RMB, and it's like super well managed in terms of doesn't have volatility. What's going to change in the future that makes all this kind of interesting is the Chinese are going to normalize their currency slowly, but maybe faster than you think. And when the RMB starts to actually trade, it's not going to be probably quite as volatile as the Brazilian real, but it's going to be way more volatile. It's going to be a very interesting currency to trade. But the carry trade itself, we go back to this thing, depends in part on your view that the country you borrow from, the US or Europe, is going to stay at very low rates. Well, I think that's a pretty much given. The US is going to be at low rates for at least 2 more years, Europe for probably longer than that. So these are great borrowing currencies. The currency you go long, which could be Australia, it could be New Zealand, it could even be Canada, it could be Brazil, Mexico. Those are all good choices. But when you go long one of these countries, you are in a risky part of the world. Even in like Australia and New Zealand, it's a commodity currency. It doesn't move exactly like commodities, but it's got a lot more volatility than some other currencies. So this is not a trade. This is a trade that's got a decent amount of risk in it. And the interesting thing about what drives the carry trade today isn't anything that happens in Australia, Brazil, or Mexico. It's what happens to global confidence. If we go through a week where we're feeling better about Europe, people they go long Brazil and long Mexico, short the dollar, short the euro. When they don't feel good about what's happening in Europe, they take the trade off. And it's not that they don't like Brazil or Mexico or Australia is the long side. They don't like having that much risk when they don't like what they're seeing out there. So they're just reducing risk. So right now, the carry trade comes on and goes off more based on whether you're scared of Europe imploding or whether you're worried about the U.S. fiscal cliff than it does about what's happening in these countries. If we go through a period where things calm down in global markets, this is going to be a lot of people's favorite trade. And so, once we get past the U.S. fiscal policy situation next spring, I'm thinking that the foreign exchange carry trade becomes a very popular item. It's also why I don't engage in forecasting the dollar versus the euro, is because you're forecasting two really sick currencies. And I'm just not sure which one is more ill. Right now, maybe Europe's a little more messed up, but we got some really big problems coming here. And so it's easier, or it's a safer bet to talk about almost everybody else versus the zero rate currencies. And I haven't talked very much about the yen, but it's also a zero rate currency. And they have a larger debt per person burden than, say, anybody else, even Greece. So at some point, they're also, they're a favorite on the short side of the carry, too. Agriculture is an interesting topic. We're in the middle of, well, we're actually at the end of the drought. The drought may not be over, but we're harvesting the crop. So, the corn crop will be what it'll be. But what's interesting to me about what's happened as we've analyzed this drought is it's made us more aware of where the droughts are around the world and where there's not droughts. But the Russian agricultural crop is down 6 or 7% because they haven't had the best weather. We're worried about what's happening in India as to how their monsoon season is going to develop. A couple of years back, we were worried about Argentina and Brazil, about their crops. Before that, we had a drought in Texas, which hit the cotton crop. What we're looking is we're seeing a very globalization of how weather's affecting markets. And it bounces around the world in different ways than it used to. And as an economist, one of the first things I look at is if we're going to have higher food prices, what does that do to inflation? Well, in the United States for next year, I'm adding like 0.3, 0.4 to my inflation forecast because of the drought. It kicks up food prices and it also kicks up energy prices a little, the biofuels connection. But the chain between the wholesale price and when it gets to the consumer, we get dampened down a lot. And the impact that it has on us as an economy is not that large. So I'm not really, it doesn't bother me that the Fed takes food and energy out of their price equations to figure out policy. It really is a volatile component. If you're in China or Brazil, it's a different story. The emerging market countries, the middle class there spends a lot more on food as a proportion of total income than we do in the US or Europe or Japan. And because they spend more on food, the way inflation rates are calculated is they're weighted based on the amount of consumption. So if the consumption percentage is higher, the impact's going to be bigger. Brazil and China are going to see food inflation that matters to them, even if we don't see it from the same impact. So from a global political standpoint, this drought and its implications are going to hit the emerging market countries politically and inflation ways harder than they're going to hit us. And they're not going to be happy about it, and they're probably going to tell us to do something about it, and none of the solution, when we're not going to follow their advice, they wouldn't follow ours, we're not going to follow theirs, but they wouldn't work anyway. There's no real short-term fix. You hear proposals about get rid of the biofuel mandate, do that. All of these things took 5 or 6 years to get into the economic system. If you turn the switch, it's not going to solve the crisis in 6 months. It might change the dynamics over the next 5 years, but it doesn't do anything for tomorrow. And the likelihood of a policy switch in an election year, of course, is nothing's going to happen. So the main thing here for me, though, is we've gotten through this drought. I'm not a good enough weather forecaster to tell you if we're going to have another one next year, but I do know that weather patterns appear to be a lot more volatile. And the last time we had a sequence was the 30s, the Dust Bowl scenario, and I just wouldn't rule out these things repeating. So we got to watch this really carefully. But the implications for our economy are not very large for next year, but for emerging markets, they're quite large. Keep them from lowering interest rates as fast as they might, and they'll have to look at their various policies on food. This is back to the BRICS slowing, a little bit on gold. This is the growth rate of the BRIC economies. They were growing, the BRICS are Brazil, Russia, India, and China. They were growing at an average of 8% in 2010. I mean, they had a problem in 2008, and they came in 2009, and they came roaring back. Then they slowed down to 6.5% in 2011, and now my forecast for 2012 is 5%, and 2013 is going to be like 4.8. The reason it's not lower is China makes up half the BRICS. And China's going from 10% growth to, say, 6.5. 6.5 is lower than the market consensus, but it's still picking up the average. Brazil has gone from a 5% country down to about 1%, and it might grow 2% over the next 2 years. India has grown from a 6 or 7% country. It might grow 3 to 4% max. I mean, it's slowing down fast. Russia is very much tied into the energy sector, but it's slowing down as well. So all of this slowdown here, aside from affecting energy, has a big effect on gold because two of the BRICS, India and China, are major league buyers of gold on the retail side. And they are getting squeezed on that. So gold is still supported by, anytime there's zero rates at the Fed, that's a good sign for gold. And those aren't going away. But the demand side of the gold equation is definitely slowing down. How much you factor that in is not quite so clear, but it's not in the right direction for higher gold prices. And it was big time in the right direction. So you still have the zero rates supporting gold, but you're kind of losing the support out of India and China. That's just a... The other thing that gets hit with the BRICS slowing down, particularly, again, this is more of a China, Brazil, India story than a Russia story, but you can't build a country without copper. And if you start slowing the country building down, you start buying less copper. And China consumes, on the margin, something like half the supply of copper, so they're like big time. The two lines here, the red line is the price of copper at the Shanghai futures market, and the black line is the price of copper, COMEX copper. So they track each other pretty well, but the direction is weaker with slower growth in the BRICS. And I don't see that turning around in 2013, although these markets will turn around before the economies. They'll kind of pick up before the economic data does. And one of the interesting things about commodity prices for an economist like me is that you think commodity prices just intuitively would forecast future inflation. They're terrible at that. They almost tell you nothing about future inflation. What they do tell you about is future global growth. When commodity prices, and I do mean crude oil, copper, those kind of things, when they all turn up together, then you're going to see much better global GNP growth 9 and 12 years down the pike. Because people are buying those things for good reasons, and they're very much a leading indicator of growth. And unfortunately, they're kind of giving mixed signals right now. They were on the downside. Now they're kind of finding bases in different places, but it's still not a hugely optimistic signal for global growth. But they're a better predictor of growth than they are a predictor of inflation. I think that's good enough for questions, and I'll open it up for any direction you would like to take. We've kind of touched on a variety of different asset classes here to kind of keep things lively. Yes?
What kind of effect will the Fed unwinding all these positions it's taking do to, what kind of dampening is that going to have?
Yeah, the question is, what's the effect of the Fed unwinding all its positions? You know, I could have paid you to ask that question. It's one of my favorite topics. The Fed is in a big bind. As you pretend that you're a hedge fund or a bank, and you borrow almost all your money short term, and you invest it in an average 8-year maturity, which I think is the current average maturity of the Fed's asset side. And your average coupon, they have some mortgages and stuff, so let's say it's an average coupon of 2.5%, 3%. Give them the benefit of the doubt. You know, if we ever get back to normal, then the 10-year bond would have a spread over the inflation rate of at least 2%, probably 2.5% or so. So if we have 2% inflation and we're back to normal, the 10-year is going to be at 4 to 4.5, which means, among other things, that the Fed's in serious negative carry. So that's not going to be, that's not even what you asked. That's their carry position. You asked what's going to happen when they sell the stuff. Well, the reason that first chart that I showed, the reason we got down to a 0 premium over interest rates is because the Fed bought $1 trillion of these treasuries. So if they sell $1 trillion of these treasuries, we're going to unwind that trade at the same time that they're slowly raising the Fed funds rate back to normal. So it's going to be a drag on the economy. And what it probably means is that the Fed will go very slow. Slow both on raising the Fed funds rate. You know, they might do it like Greenspan did, and he did it like 17, 25 basis point increments. They might do it in 17 increments, but they might take twice, instead of doing it every meeting, every other meeting or something. You know, they might stretch it out so that they could sell a little, raise the rate, sell a little, raise the rate to dampen it out. What that means is that they stay at low rates way longer than they should. Now, I'm not going to forecast inflation out of that, although many people do. I'm going to take what I consider the safer forecast and forecast a weaker dollar. Because if the global economy is sufficient so that they can be raising rates and they can be selling into it, then staying at a lower, easier monetary policy longer means that you are going to love my carry trade. That is where, you know, where I think the money will go. And then if there is a vicious cycle pushing the currency down, then at some point you're in the 70s and you'll have to raise rates faster. But we'll get there later. We'll have another seminar way before then. The other thing to think about is the Fed actually has a balance sheet, and they have equity. We don't think of the Fed as a corporation, but it is. It's structured like one. It has a board of directors. And if the Treasury bond were to go from the current yield today to only 3%, the Fed is in negative equity. Now, the Fed, unlike you, me, and everybody else, does not mark anything to market. So they're not going to report negative equity, but everybody's going to know that the value of the assets they hold are no longer, they've broken the buck, so to speak, or much lower. And so the unwinding process will be that much more difficult. So when the Federal Reserve, where some of these FOMC and Fed presidents talk about there being almost no cost to more quantitative easing, all the costs are in the long run, but they're enormous. And we'll find out how that plays out. But my conclusion is that it slows the process of raising rates because they'll balance the sale of assets with the rate rises. They'll keep a policy accommodative longer, and that makes me more of a bear on the dollar on a 5-year view. But you have to get past the fiscal cliff and be more optimistic about the economy before that should kick in. You know, it's too early to take those bets now, but you do want to be ready. Is that where we were going? Okay. Yes? With
the Middle East tensions and Israel's statement this week,
right.
Do you ever see crude under $75 a barrel again?
Let's just say that 125 is slightly more likely than 75. Just to, you know, set it at 100 and do the easy math. But 75 is entirely possible if the world calms down and China and India and Brazil stay slow for a little longer and Europe kind of stays a mess, but we know it's not going to be a crisis. Then you're talking about really taking away a lot of the demand pressures you had at the same time supply is coming out of the woodwork. And 75 is not, I mean, I don't know what probability I should put on it, but I'll make up a number right now. You know, 10, 15, 20% probability of that happening would be totally reasonable to me. You should not rule it out. It's not like a not going to happen thing. It's a, you know, 1 in 5 chance would be, I wouldn't argue with anybody with that. However, the Iranian thing, the Middle East crisis, crises trump fundamentals any day of the week, any day. All you have to do is scare the hell out of people, and the price can just zoom up for a short term until we see if the crisis happens or not. So 125 is equally possible in the short run, but probably less longer lived. If it gets to 125 and nobody bombs anybody, then it's going to come right back down. If it gets to 125 and worst case happens, then, you know, we can talk 150. So it's a smaller probability maybe of it happening, but it could be worse if it does, because just the nature of what you're talking about in terms of causing it. Yes?
How do you account for the rise in corporate profits?
The question is, how do you account for the rise in corporate profits? So let me ask it slightly differently. What corporations did, global corporations, but particularly U.S. ones, did after the 2008 problem is they shed jobs like crazy in 2009. So they reduced their expenditure base, and let's see where we are. Okay? By 2010, they were getting their profits back. They had a lower base of expenses, they weren't hiring, and they were seeing some business come back from a lower base. And so by 2011, they're sitting on a ton of cash, their profitability is respectable, and their expense base is lower. And one of the things that U.S. corporations, but global ones too, have gotten very, very good at maintaining a reasonable earnings rate even without revenue growth. So corporations are managing very, very tightly in this environment their expense situation so that they can get through a tough revenue period and still have some profits left, which is why they're not spending the cash they've got. They're not spending it because they are using it to buffer 2013 if it doesn't work out so well. If we have this fiscal cliff and the government shuts down, or we have a big fiscal policy cutback or tax hikes, they want to be ready so that they can go through that and they don't have to cut the jobs they had to do in 2009. Cutting jobs is a really bad way to get through a tough period. So I think they're hoarding their cash for excellent reasons, and they're not going to let it go till they're more let it go is not the right word. They're not going to invest it and expand and do more acquisitions until they're more confident about the future. And the future is U.S. fiscal policy, Europe better, that you can see a light at the end of the European tunnel, and that you think China's found a base. You need those three things. Yes?
Just to follow up, I'm sure you heard the joke about Harry Truman saying he wanted a one-armed...
Ah, yes, I've heard that a few thousand times.
I don't know if the group has heard it or not. Well, you don't have any... What would prove you wrong then, as we say? On the other hand, where would you... What if you're wrong? How would we know if you're wrong?
Oh, you'll know easily. Just wait and I'll be wrong. Yeah. But, you know, the biggest thing that you can look for on all of these markets is actually the slow grinding up of the S&P 500, whether that continues. That is an exceedingly positive sign that markets are calming down, that fear is dissipating, and that the future may not be what you want it to be, but you're not worried as much as you were about the disasters. So the equity markets will give you one signal that things are getting more and more positive. If something negative happens, we're not going to need to know what it is. We're all going to know instantly what it was. You know, some big financial crisis somewhere or something else, or the U.S. shuts the government down. We're all going to know about that. So those are the things that would happen that would be the disaster scenario that would make you happy that you still own some of these treasuries. But the positive side is much more of a slower grind. And so there you don't get an email that things are better. You just, every month that goes by that we don't blow up, it's a more calming thing. And as things stay calmer longer, the most important thing that happens is risk-taking starts to increase a little bit. And as risk-taking increases, a lot of these trades come into play. The carry trade comes into play. You can take more risk in a lot of different places. So, you know, you're not going to know I'm wrong till we know everybody else is wrong too. I used to be way more of a one-handed economist, by the way. It's a little bit constraining to have that disclaimer up in front and have your compliance person, did you give any investment advice? You know, so my job is to frame the issues, which makes me have two hands. But we do try to at least have a more clear opinion on which side would come down on it from an economics point of view. You still get to figure out the trades. Anything else? Yes?
Which markets do you see to be most volatile coming out of the election, depending on which way the election, the outcome is?
As I look, the question is, which markets will be more volatile coming out of the election?
Depending on the outcome.
Depending on the outcome. And the interesting thing for me on this election is I try to look at my own GMP forecasts and things for next year, is that, you know, personally I have a view about who I'd like to be president or whatever, but it turns out what matters for me most is figuring out who's going to run Congress. And I'm not even need to know who runs Congress. I need to know how large is the minority that might say my way or the highway. Because it's the my way or the highway people that will shut down the government and cause us to go back to 10 or 11% unemployment. If we have a double dip recession, it will not be pretty at all because we haven't had the recovery from this one. So normally we have like 7 years after a recession. By the time we have the next one, we're kind of like ready. We can take it. We're not ready. So if we get hit with a tax hike and spending cuts, we're talking 11% unemployment. It's just going to be brutal. So when I come out of the morning after the election, I'm counting votes in Congress, and I'm looking for the extreme people in the Democratic Party and the extreme congressmen on the Republican Party, and I'm trying to figure out who doesn't compromise. And if I can find a majority that will compromise, I will be much more bullish. But the Obama-Romney has more to do about social issues and foreign policy, but neither one of those guys, if they come in, is going to be able to control Congress all that much. Congress has got a life of its own these days. And Obama has certainly learned that, but Bush was learning it too as things went along. Gone are the days when a Reagan in 1986 could have a bipartisan tax reform. I mean, Democrats control Congress in 1986. And Reagan and the Congress and the Democrats came together with a very important tax reform that really made for a much better growth rate over the next 15 years. I can't see, even if Reagan came back, I cannot see this Congress or the new Congress reacting quite the same way. So, so as I count votes toward compromise or not compromise, I reevaluate my probabilities of whether I should reduce my equities, buy a few of those treasuries, and close my eyes. You know, which is what you should have done in Japan back in the mid-90s, is you should have bought the JGBs when they were at 2%, because now they're at 1%. I mean, this stuff happens. And I certainly won't be a buyer of oil if we're going to go into a recession. So, you know, it's that probability. And right now I put the probability of the worst case at around 20–25% probability. And so I'll reevaluate that probability right after the election.
Just as a follow-up, is there a magic number that you're looking at in terms of congressional makeup?
No, it's all very complicated, and there is no magic number because if you look at the polls, 10% of the public thinks that Congress is doing a good job. And we're trying to find these people to see if they're for real. But the thing is that if you ask people in their local districts, do you like your congressman? Most of them have approval ratings between 30 and 60%. I mean, even the worst ones, whoever they are still liked way better than Congress as a whole. I mean, your guy is way better than everybody else's guy. And so it's a very local phenomena, and local issues can really dominate, not national issues, and then they get to Washington and have to decide a national issue. And you know, and some of the candidates on both ends of the spectrums will do better to oppose than they will to compromise. Yeah.
I don't mean to monopolize, but I just had lunch with a gentleman from the Federal Reserve, and he maintains that Congress could kick the can down the road a couple more years.
The question is
Doesn't have to agree about
whether Congress can kick the can down the road. Now, the Europeans got very adept at kicking the Greek can down the road, and then they kicked it, and all of a sudden, it still blew up. And I think that we are very close to that stage where kicking the can down the road will not produce a very good market response. I mean, that is, there'll be a negative feedback from the market to the politicians if they kick the can. But a different answer to that question is, would they kick the can? There's a lot of pressure early on in January, February, right when the new Congress gets in, to pass some kind of continuing resolution to get rid of the spending cuts for a year. And they might do that. So that's one possible kick the can. But on the tax side, I don't think they're going to kick the can. I think they're going to fight that one out and decide what they want to do. So on the spending side, they might kick the can down the road. And kicking the can means they just say you can spend, each department can spend at their current level for another year before we let the budget process kick in. But kicking the can is not effective as it used to be because the markets have gotten some experience with Europe, and if you just kick the can, they come back harder at you. Just ask Spain and Italy, Greece.
So what do you think the market wants? Does it want to see higher taxes or lower expenses?
The market actually doesn't want these things. The market is a generic average of everybody. And you know, there are plenty of investors that would like to see, that feel like any long-run plan is a good plan. It's just so I can plan. And then there's another group of investors that really do want lower taxes and feel very strongly that that's the solution to longer-run growth. So the market is an averaging process, and I don't humanize it as much as the average economist. So I'm not going to go that way. The market will always surprise you anyway because it adjudicates these opposing forces. So I would probably, whatever the initial reaction is, I'd short it. You know, I'm a contrarian for the first 24, 48 hours because I think the indirect effects and the long-term effects are bigger than the short run. And so you got to wait till people kind of wake up and see that. But we'll have fun the day after the election. Anything else? Well, thank you very much. We've had a nice tour of the markets.